Welcome back. This is day something in the Road to Profitability series. In this video, we're going to be talking about macros and time-based sessions. So basically, how to operate time within a session. So first off, this is going off the last video. This is the New York session. So I use 12 p.m. or I use 8:30 a.m. to 12 p.m. This is the opening price. So think of the midnight open as the premium discount level of the daily, and for the New York session you can use the 8:30 opening price for this session. So we're going to be doing, sorry, let me just hook this on, 8:30 premium time-based premium discount level of the session. And then over here we have the midnight. Let's just move this over here. So this is still relevant, but we're going to be looking at this for right now. So what I want to point your attention to is these macros. You can kind of think of these macros as like little, like just how the daily candle has sessions, the sessions have macros. And these are little programs in the algorithm telling price what to do and when. So in these macros, you can expect price to expand, reverse, and rarely, and you don't want to see this happen, consolidate. But you wouldn't expect this. So you would expect these macros to expand or reverse. If you notice that these macros are consolidating, like this one right here, don't touch it. That's a very, very low probability condition, and you don't want to operate within a consolidating macro. However, this rarely happens, especially with these two macros right here, which we'll dive into. So you're going to expect these macros to either 1, expand, or 2, or 2, reverse. And for me personally, when I trade on my XFAs, when I trade on my prop firm accounts, and when I eventually get to a live, I'm only trading AM macros in New York. So I only trade 9:45 to 10:15. We'll mark this with lines. And 10:45 to 11:15. And if I get a win here, I'm not even going to be trading this one because I'm done for the day. And then this is our third AM macro, but this has its own specific property. And ICT does teach macros. However, he teaches them from the last 50 of every hour to the first 10 of every hour. So they look something like this. So it'd be 8:50 to 9:10, 9:50, 10:10, 10:50, 11:10. However, from personal experience and just from other people I've seen on the internet, if you expand the macros 5 minutes each side, they are way more effective and easier to trade. So when you're using macros, just trust me, just add 5 minutes to each side, and you'll do a whole lot better. So these macros happen. They're 30 minutes long, and they happen every 60 minutes. So these would be part of a more advanced concept called time cycles. That I know I say this a lot. We're not there yet, but these are relevant. That it's 30 minutes long, every 60 minutes. This is how the algorithm delivers price. So this one, and this isn't taught by anybody. This isn't taught by ICT. This is own personal experience. This first macro right here will typically generate liquidity for the second macro. What does that mean? Well, market will only hunt liquidity in the form of stops, rebalance the inefficiencies, rebalance the equilibrium, and generate liquidity. This last one is very specific to time because we generate liquidity in the form of highs and lows during Asia session. We generate liquidity in the form of highs and lows during lunch hour, which is 12 p.m. to 1 p.m. in between the AM and PM session for New York. And that's basically it. However, I've noticed through personal experience that this first macro acts almost like an Asia session of the New York. So what does that mean? You can see here, in this macro, when we're expecting a reversal or expansion, we are held in a very tight range. This is what some people would call time distortion. The algorithm is keeping price in this tight range to generate liquidity in the form of sell stops down here for price to come and deliver or grab during this macro. Right? So you can see this is the lowest low of it. We have another low right here. We have another low right here. We have another low, or these two were taken out to be fair, but we did have a lot more lows. So we have 3 lows in this macro. Let's make this a little skinnier. 3 relative equal lows that are primed to take. When you see smoothness in the market, when you see stacked lows like this, always expect the algorithm to hunt this. The algorithm always hunts relative equal lows and highs. And what is a low? Down, up, down, up, down, up, right? So this macro, in my personal experience, isn't good to be traded. It's like trading Asia. It primes liquidity for this next macro. So when we come up here, and this macro starts at 945, and we hit a key level. What key level? Wednesday's high, not the previous day's high, not Thursday's high because this is Friday, but a previous day's high. We had SMT as well, I believe. I don't quite remember, but I did take this trade live. I'm sure I could actually. I'll pull up the execution too in a second. So we hit this key level. I'm pretty sure we had SMT, which I forgot I didn't teach yet, but it's just a Kraken correlations. One of the assets took it while the other one didn't, and we're showing some kind of weakness in the market, failure to get up, and we start displacing down. So right here we have an inverse fair value gap, which didn't get respected, so let's get rid of that. We have we create a fair value gap on the way down here. We inverse this fair value gap, right? We have a market structure shift, right? What we want to see. So we're looking at market structure shift to confirm this reversal on the 1 minute, and we're looking at these inefficiencies price is making. And once we get a pullback into it, we take a trade off this. So right here, I entered off here for other reasons. I entered like right about here, but let's just say, for this example, because I think it would make it easier to understand, is this wick goes into here, right? I obviously just drew that in, but this happens all the time, so we're going to use this as our trade idea. So we wick into this fair value gap. You can see we have a swing high right here. So let's put we already rebalanced this wick. So I wouldn't expect this high to be taken out. And if this high was taken out, I'd expect this high to be taken out. So I'm putting my stop here. This invalidates my trade idea. So enter off this fair value gap right off the top. This is our risk to reward tool. Let's make it blue so it's easier to see. That did not make it easier to see. Let's get rid of this New York background. How about that? That's way better. Right, keep it green. Maybe a little thicker. And we're going to be looking for this generated liquidity for us right here. So let's go for the lowest one, because if this one gets taken out, I expect all this to get taken out. So this is our target, just based off time, right? If you just forget about entry models, it's time and then price. So if you just forget about entry models and you just look at price by itself, you can enter just off time alone. When this macro opens and we have primed lows there and we show displacement down, you don't even need this retracing of the fair value gap. It doesn't matter. It'll give you a better risk to reward, but once you see this fair value gap get created, you can just enter off the fair value gap creation at the close of this candle. Because we know price is going lower. We don't need that fair value gap. And that's more advanced, but even just after we hit this key level, we have this time priming price, and this time we expect with high confidence, we expect this to deliver price. Literally just 9:45 opens. 9:45 opens. Maybe we turtle soup this, that's why it wouldn't instantly enter, but 9:45 opens, you can just expect this to rip all the way down to these lows. Right? And why? Why? Because we generated liquidity, and now we hit a key level. We hunted stops on a higher time frame. Now we expect to hunt this generated liquidity. And then on a higher time frame, notice how we have time-based generated liquidity here. It just creates relative equal lows that weren't taken out. There's London lows too, which is important, but it doesn't matter for this context. We're above midnight open, so we're on a time-based premium level, a time-based session premium level on the daily and session. We have an unfilled 15-minute fair value gap that the algorithm wants to rebalance inefficiencies in the marketplace. We have generated liquidity down here on the higher time frame, and we have generated liquidity on the short-term basis in the New York session. So this is all you need, right? Just time. It doesn't matter how you entered. You could have taken the fair value gap, taken this inverse, Could have taken the rejection block up here. Could have entered off time alone. Just off a market structure shift, just off a change in state of delivery, off of this breaker. It honestly doesn't even really matter what your entry model is. Once you get deeper into trading, you realize that the entry model is just there for like a little confirmation to set up your risk. It's not the end all be all, because a lot of people, this is what separates ICT traders from pattern traders, is the fact that there's a narrative, there's price, not price, there's time. Pattern traders see, oh, fair value gap after a stop hunt, so liquidity sweep plus fair value gap, I'm in. They would have taken the same trade, but it's a different context. They don't. It's those people will get absolutely rinsed in the marketplace on a long enough time frame if you're just taking patterns. You have to have a narrative and you have to have price align. So we're looking for our entry model at certain times. So I only trade these times. I took, and I'm gonna show you my exact entries. I have a screenshot of it. You want to be aligning time and price, specifically time first. So this was Friday, right here. Traders. All right. So right here, this is the same exact trade. I have other stuff marked out. I expected this to be a breakaway gap. I didn't expect this to be traded back to. Sorry. Yeah, I didn't expect this to be traded back to for different reasons, but I entered in. I guess I think I entered in. I want to say just off of the strong displacement leg. I don't quite remember. I think I entered off the strong displacement leg before we even closed, just because of the time and the narrative we had behind this trade. I didn't wait for like a lot of specific entry criteria. Just off time alone, I really took this trade. So come down here, we have devil marks, which is, as you know, inefficiencies in price are just like fair value gaps have to be rebalanced. Devil's mark plus fair value gaps. I misclicked here. I meant to go lower, take out those relative equal lows, but I accidentally pyramided my position and taken a partial instead of taking a partial, so I just exited my whole position because it was messed up. Yeah, and then this is going to be our next one that I show you, another time-based level. This is ICT Silver Bullet, right down here. So this is my second trade of the day. Again, still in the macro. We took out this generated liquidity, but we still have a lower time frame draw, and we have these relative equal lows, which aren't really time-based lows, right? We have these are time-based relative equal lows right here, right? These two. However, these aren't the strongest drawn liquidity because it's not in this specific macro, and it's not London and Asia lows. So this was a potential drawn liquidity, but it wasn't like the end all be all. I wanted to see price come all the way down and take out these. That was my higher time frame draw. So after I took profits, I risked 8% of my profit, so very low. I risked like $200 on this trade, and then coming down here, I only risked like 50 to 100 because I'm already up for the day and I don't want to risk too much of my profit. So we came up here, still in the macro, still expecting to distribute, expecting these fair value gaps to hold, this internal range liquidity, exiting on the external. All right, yeah, remember that. All right, so entering on internal range liquidity, targeting this low, these Asia lows. All right. ICT Silver Bullet, ICT's True Silver Bullet, which I'm sure you've heard of the Silver Bullet, but this is related to market maker models. I believe it's True Silver Bullet. So I don't wanna get into that yet, but it was the Silver Bullet that aligned with time inside this macro. I entered, came back, got break even because I was trying to keep my risk low for the day because I'm already in profit. But yeah, again, it's still valid because we're in the macro. And then we deliver price. We have a continuation in this time cycle, in between macros, which is okay, it happens. And then in this macro, we already delivered price, we already balanced this inefficiency, so this macro is perfect to frame a reversal. You can see we come down here, we reverse, we don't really expand yet, but we do reverse, and then coming into the lunch hour, we just kind of consolidate because we hit our objective for the day and the week is over. New York PM, very lackluster, nothing special here. So if we reverse in a macro, like say this one we reversed, but we didn't really expand yet. You could expect in the next macro, or the time right after this macro to expand. In this case, we already hit our objective, so there's nothing else to target. So we did reverse in this macro, but there's nothing to target. So yeah, that's how I use macros to trade the New York session. This applies to London session. However, I don't trade London because I'm on the East Coast. And this can be applied to New York. However, this is like a horrible looking New York. It's usually a lot better than this. But you can use the same idea. Remember the last 40, I use 45 to 15. You can use 50 to 10. And expect an expansion or reversal in this time. And then keep your entry model very simple. Just liquidity sweep plus for value gap, liquidity sweep plus inverse for value gap. It could be just the change in state of delivery. It's really up to you and your personality and how much risk you're willing to put on. And it's really up to you, but just have a very specific allotted time and desired narrative to enter in a trade. So like we have to take out a time-based level, targeting a time-based level in this time to get in above this premium level or something, right? Have a very specific time entry model in risk rules, and then have a very, very loose like pattern and price action model, right? Because people obsess over the, oh, what am I going to do to enter? What's my best entry model? What's the best entry model there is? And it doesn't really matter at the end of the day. It's really just what time and narrative is happening in price right now. So without extending the video too much longer, that'll wrap up the time aspect. Way down the line near the end, I'm going to be talking about time cycles and maybe some quarterly theory, which relates to time, and probably there's a few more things about time I could share, but this is really the bulk of it. You can make money just off. You could end the Road to Profitability series right now and make money. So I'll leave it at that, and I'm gonna plan out the next video. I'll see you then.